very warm welcome to today's edition of Money Moves. I am Melissa Enoch here at the FMDQ studios in Lagos.
And I am Grace Agbarago. It's Wednesday, the 15th of October. We thank you for joining us at this time on the show.
All right, let's tee off with your news now. In Namibia, in central banking news, the Bank of Namibia has cut its key repo rate to 6.50% by 25 basis points, a move aimed at supporting economic growth and lowering borrowing costs for businesses and consumers. Let's take a listen.
The Monetary Policy Committee of the Bank of Namibia decided to reduce the repo rate by 25 basis points to 6.5%. This was done to continue supporting the domestic economy while safeguarding the peg between the Namibia dollar and the South African rand. This was done following a review of international, regional and domestic economic developments. Our decision to reduce the repo rate is entirely data-driven. Let us consider the factors in the domestic economy that has informed this decision. Domestic economic activity has weakened, inflation remains subdued, while growth in private sector credit extension has improved further, although it remains relatively weak. The merchandise trade deficit has narrowed further, while the stock of international reserves remains sufficient to maintain the currency peg and meet the country's international financial obligations. Real gross domestic product growth has surprised on the downside, fallen to a post-pandemic low of 1.6% year-on-year in the second quarter of 2025, from 3.3% during the corresponding period in 2024. This poor performance was primarily observed in the manufacturing, fishing and agriculture sectors.
At the 2025 annual meetings of World Bank IMF in Lima, the International Monetary Fund today presents its latest fiscal monitor titled Spending Smarter: How Efficient and Well-Allocated Public Spending Can Boost Economic Growth. The fund projects global public debt to rise above 100% of GDP by 2029, the highest level since 1948. Under a higher risk scenario, debts could reach 124%. The IMF's Director of the Fiscal Affairs Department, Victor Gaspar, shares insights on how countries can optimize public spending to drive sustainable growth. Let's listen.
The global public debt prospects and risks have deteriorated further since our last meeting in April. In the Fiscal Monitor, global public debt is projected to rise above 100% of GDP by 2029. In such a scenario, public debt would be at its highest level since 1948. Moreover, the distribution of risks is tilted towards debt accumulating even faster. With a 5% risk, debt would reach 124% in 2029. The world public debt landscape is very diverse. This map displays the fund's fiscal risk assessment based on the latest debt sustainability framework from Article 4 staff reports. Countries differ widely in their deficit and debt levels. Many major economies have public debt greater or projected to go over 100% of GDP. Among the G20, these are Canada, China, France, Italy, Japan, the UK and the US. These countries typically have deep and liquid sovereign bond markets and often broad policy choices resulting in their fiscal risk ratings being moderate, yellow, or low, green. In contrast, many emerging markets and low-income countries face tougher fiscal challenges despite their debt often below 60% of GDP. Their policy options and funding access are limited. As the map shows, 55 countries are assessed at high, pink, or distress level, red, of fiscal risk. In many cases, relatively low debt to GDP ratios are accompanied by low debt tolerance. Beyond the present, fiscal risks loom large.
The International Monetary Fund has released its latest World Economic Outlook for October 2025. IMF Chief Economist Pierre-Olivier Gourantia presents the fund's assessment of the global economy, highlighting key trends and policy recommendations to help countries manage current challenges. Let's pay attention.
The good news is that the growth downgrade is at the modest end of the range, with growth projected at 3.2% this year and 3.1% next year, while inflation has increased modestly and is proving more persistent. Now, what explains this modest impact? First and foremost, the tariff shock itself is smaller than initially feared, with many trade deals and exemptions. Most countries also refrained from retaliation, keeping the trading system open, and the private sector proved agile, front-loading imports and rerouting supply chains. Second, financial conditions remain loose, in part because of a weaker dollar. In some countries, such as Germany and China, fiscal policy turned expansionary, and in the US, an AI and tech-driven investment is booming. Yet, despite all these offsets, the tariff shock is here, and it is further dimming already weak growth prospects. This is clear even in the US. Growth is revised down from last year, the labor market is weakening, and inflation has been revised up and is persistently above target, signs that the economy has been hit by a negative supply shock. Where do we go from here? The outlook remains fragile and very sensitive to news on the trade front, as I'm sure all of us have noted. Flaring up trade tensions with the potential for supply chain disruptions could quickly lower global output by as much as 0.3 percentage point, as we explore in our downside scenario. Besides trade tensions, I want to quickly flag 4 other downside risks. First, there are echoes in the current tech investment surge of the dot-com boom of the late 1990s. It was the internet then, it is AI now. We're seeing surging valuations, booming investment, and strong consumption on the back of solid capital gains.
The World Bank IMF annual meetings continue in Lima with a special seminar focusing on productivity in the digital age. Experts are examining how new technologies and artificial intelligence can drive the next wave of productivity and what policy frameworks are needed to ensure that the benefits are broadly shared. Let's take a listen and join.
People a day. It's like an airplane falling out of the sky every day. That would be a national, global crisis. With self-driving cars, we can improve safety meaningfully. And for anyone, how many of you have been in a Waymo yet? Okay, a lot of you have a lot of joy to come, as the managing director knows. It is fun, it gives you back productivity, and it is safe. It's already about a quarter of the drives in San Francisco. It's a tourist magnet. So that's one example, but there are plenty of others in the way people work, and everyone's already using it in photos and search and everything else.
So, Mr. Elomuluo, as both Simon Johnson and Kristalina Georgieva have mentioned, we in the United States have the luxury of having a lot of this technology developed here, and we have a lot of people adopting it. And I'm curious how this looks to you from your viewpoint in Africa. Is AI making a difference now? How big a potential do you think it has to solve some of the problems and lift the growth of African economies? And also compliments on the socks.
Oh, the audio, I thought was on the back. David, thank you. Good morning, everyone. When we talk about productivity in the digital age, it's really about people we're talking about. Productivity is not just about, can you hear me? Can you hear me? Can you hear me? Okay. Productivity is not just about output per worker. Productivity is really about opportunity per person. In Africa, we see this age as we see the challenges and we see the prospects. We have leapfrogged in the past, and we think that this digital age presents a great opportunity to leapfrog further in the area of healthcare, agriculture, and even in the area of electricity. But for us to take advantage of this, there are structural barriers that we need to fix on the continent. We have infrastructure deficit on the continent. Access to electricity is so critical for the advancement of AI and, of course, the productivity that comes with it. We do have this challenge on the continent. We also have access to capital challenges that affects entrepreneurs in this space of AI and co. And so we need to find a combination therapy that addresses these challenges for us to reap the benefits that we see. We need to see a concerted and deliberate massive.
That live was from the seminar focusing on productivity in the digital age. In other news, PwC Morocco has inaugurated its Digital Resilience Center in Casablanca, the firm's first in the MENA region. The facility will provide strategic support for data protection, business continuity, and financial crime prevention. Launched amid growing cyber and AI-related risks, the center aims to help Moroccan and African companies strengthen digital security and resilience. Finally, on News Now, South Africa has signed a trade protocol with China to begin exporting 5 types of stone fruit: apricots, peaches, nectarines, plums, and prunes for the first time. The agreement, signed by Agriculture Minister John Steenhuisen and China's Customs Chief Sun Meijun, is expected to unlock about 400 million rand in export value over the next 5 years. I am Melissa Enoch, and that's it on today's edition of News Now. The show returns shortly with Grace at the Archives Room, giving us our markets round. Stick around. Welcome back to Money Moves. Let's now go over to Grace for today's markets reviews. Hello there, Grace.
Hi, Melissa. Let's now track how the markets are wrapping up for the day, starting off with the equities. It's a positive trading day for the African equities, as you can see on your screen. The Nairobi Securities Exchange climbed 1.12% to 172.24. Africa's biggest exchange, the Johannesburg Stock Exchange, rose 0.19%. The Zimbabwe Stock Exchange firmed 0.51%. In West Africa, the BROVM advanced 1.29% to 337.19. And here in Nigeria, the NGX All-Share Index edged up 0.02%. Let's do a quick round on some of the Pan-African currencies. The Naira weakened 0.53% to 1,465 Naira 07 kobo to the dollar, while the Rand edged up 0.28% to 17.33. The CFA franc strengthened 0.52% to 564.07, and the Egyptian pound was steady at 47.65. The Kenyan shilling was marginally weaker at 129.25, while the Moroccan dirham is 0.29% to 9.19. Let's switch into the commodities data deck, beginning with energy prices. Oil prices ticked higher as supply concerns provided some support. Brent crude gained 0.56% to $62.74 a barrel, and US WTI rose 0.85% to $59.18. Natural gas fell 1.45%, while Arabian gasoline edged up 0.49% to $1.88 as at 12:38 GMT. And finally, two soft prices. Cocoa dropped 1.70% to $5,799 per ton, and sugar declined 1.20%. Coffee gained 3.07% to $411.90, while cotton slipped 0.31%. Palm oil was almost flat at $1,027.88 as at 12:48 GMT. And that's how Money Moves markets today. Back to you, Melissa.
Grace, thank you very much for those market updates. And that's it on today's edition of Money Moves. From all of us here at the FMDQ studios, we say thank you very much for watching and bye for now.